makers and market movers. This is The Pulse with Francine Lacqua.
Good morning and welcome. You're watching The Pulse. I'm Guy Johnson in London. Francine Lacqua is out today. What do we need to know? Let me tell you what we've got coming up on the programme. European stocks a little lower this morning. The yield on the US 10-year hitting its highest level since November. Investors are now awaiting tomorrow's key US inflation data. An interesting conversation earlier with the former St. Louis Fed President, James Bullard. He's telling Bloomberg that 3 cuts this year from the Fed, very much the base case scenario. We're going to bring you more from that exclusive interview. Plus, the Japanese finance minister says he's watching FX movements with a high sense of urgency. This is the yen hovers near that critical turning point, 152. We're at a 34-year low. The market very short the yen right now. We need to wait for that CPI print before we get some sort of intervention. Let's talk about where we are with the map this morning. This is what the markets look like across Europe. Little softness out of Germany today, but elsewhere in Europe, I think we're just basically unwinding the gains that we saw yesterday. We are anticipating, obviously, that everybody's going to be really kind of on hold until we see what that CPI print looks like tomorrow. In terms of what US futures look like, let me take you through the picture right now. A fairly flat picture once again, unsurprisingly, given what is going on with that CPI print and the anticipation around it. S&P futures barely budging. Nasdaq futures a little soft, but I wouldn't read too much into any of this if I was being honest. The price action will have to wait for tomorrow for that print to come out. Cross asset, let's take a look at some of the other asset classes we are watching. Similar kind of picture in so many ways. Brent, we're seeing a little bit of a tick up now. We're back north of 90. 90.57 is where we're trading right now. Gold continues to climb. Iron ore actually is probably the biggest story out of this morning's trade and has materially moved some of the miners out of Europe. Iron ore up by over 4% out of the Asian session. Sorry, up close to 4% out of the Asian session. That means that we have seen European mining stocks outperforming this morning. And there you go. There's the dollar-yen trade. 151.91 is where we're trading right now. We're waiting to see exactly where the line is. The market thinks it's 152. It's a little bit north of that. Let's talk about the news that we're getting right now. This is a key piece of data. So this is the lending survey, out of the Eurozone that the ECB publishes. And what this tells you is about kind of the credit condition story, the credit impulse story, which has been quite negative for a while. So let me just read you some of the headlines. Banks see more net tightening in standards for firms, terms and conditions. 2 firms are broadly stable. So the terms and the kind of cost of money broadly stable. Banks see a positive income effect from rate hikes as they start to fade. That is what is happening to the banking sector as a result of that. Eurozone firms' loan demand declined substantially. So demand has declined really quite substantially. And credit standards for firms tightened a little. So remember, this is a diffusion index. What this tells you is not about kind of what is happening big picture. It basically tells you kind of month on month. Our credit standards, is credit lending improving, declining month on month, and the rate of change on that. Alex Weber joins us now from Frankfurt. Alex, this is a key piece of data that certainly Philip Lane has been citing recently as something that we want to be paying attention to. What can we deduce from it about what the credit impulse looks like in the Eurozone?
So one key piece of data is about the credit standards, and they've been broadly stable, which isn't much of a surprise given they've already tightened pretty substantially after the ECB's rate hiking cycle. And rates have been stable for a while, and credit standards haven't tightened further. So that's not much of a surprise. What was a little more surprising in this survey was that loan demand actually fell further, though banks had expected a slight increase. That tells us that maybe the high level of interest rates is weighing on the economy a little more than officials had maybe expected. That should, in theory, speak in favor of faster interest rates cuts. The question is whether that's going to be enough to sway officials this week. Probably not, because they are also watching a load of other data that has come in a bit more mixed.
Okay. In terms of kind of what we should expect in terms of the economic impact of this, what are we looking at? If credit demand is starting to dry up, where do we see that in the Eurozone economy? If demand for credit is weak, that should be a significant impact on the capital-intensive industries, the industrial sector that has been actually performing reasonably strongly recently.
Yeah, exactly. So that should mostly hit investment from firms and thereby the manufacturing sector. For example, in Germany, we've seen it's been doing much worse than the services sector. It's still contracting as of late, and that should continue to be the case probably as long as corporate loan demand remains weak. There was loan demand from households was a bit better. There was also some easing in credit standards for household loan purchase. That may be a bit a sign that lenders already expect some interest rate cuts to happen later this year. But yeah, as you say, for manufacturing, this doesn't look good.
It doesn't look good. It's interesting that we are seeing outperformance of European auto stocks. Some of the noises coming out of the industrial sector starting to maybe improve a little bit. Alex Weber, thank you very much indeed. Alex Weber joining us from Frankfurt. Jari Stehn is the chief Europe economist at Goldman Sachs and joins us now on set. The lending standards, I think, is interesting. The demand for loans that we're seeing is really interesting out of this survey. When you look at this data and you see that demand for credit is beginning to kind of weaken materially, what does that tell you about kind of where we are in the cycle, how close we are maybe to the bottom?
Yeah, I think it's telling you that demand growth in the economy is still weak, particularly in the industrial sector. And I think that squares, generally with particularly the hard data and the German data as having been very soft.
Yep.
But you also see in the credit standards, which I actually think are the more important part of the survey, that things are still tightening, but things are now tightening at a slower pace. And I think that also gives you a little bit of hope that we are through the worst in terms of the credit impulse, and that the forward-looking indicators are beginning to look a little bit better. And I think that squares also with what we're seeing in the surveys, in the PMIs, in the more forward-looking surveys that are a little better. So I think it's consistent with the spot data still being very weak, but the forward-looking indicators looking a bit better.
So if you're Philip Yain, if you're the chief economist over at the ECB, you're citing this survey as being very important. What would your take be to the Governing Council when it meets later on this week?
I think for now, I would say that we need to see more data to confirm that the inflation deceleration is on track. So I think we're very unlikely to get a big shift in the message this week. But I do think that the weakness in demand that we are seeing, I think the indications on wage growth slowing, and I think the inflation projections all suggest that the first rate cut is coming nearer. We think they will reiterate this week that we will see a lot of data by June, that we will be able to determine by June whether to start lowering interest rates. And I think the cut in June is very likely. And the debate now really is shifting towards the pace, whether you might want to go quarterly or you might want to go back-to-back or do a mix.
What do you think?
I think that a back-to-back pace is more likely, at least initially. I think we have strong evidence that policy is restrictive.
Yep.
I think we are gaining confidence that inflation is coming back to 2%. The Governing Council has decided to wait a bit longer than some members would have preferred. And so I think once the process gets underway in June, I think the path of least resistance would be to do a series of cuts initially, so June, July, September, because everyone, I think, can agree that even after 3 cuts, policy is still restrictive, and then you reassess in September where you stand.
So that raises the question, why do 325s? Why not do a 50? If we're going to front-load policy, why don't we just front-load policy?
I think central banks like to be predictable. They don't like to move in big increments very suddenly. I mean, they had to when inflation rose very rapidly, but I think that was a little bit of a special case. And they don't like to move in 50 basis point increments, particularly with the first move. And so I think it's more likely we start with 25. I don't think there's going to be a strong message this week or in June about committing to a particular series of moves. I think President Lagarde has been...
So why not? Why? It's an interesting debate. Why, if you don't want to surprise the market, when do you need to start preparing the market for that more tightly packed sequence of rate cuts which could be coming? Now, the market in some ways has already got that price, so in many ways maybe you don't have to. But when does that communication process start?
I think you do it with the data. I think, as you said, I think they can be happy with how things are priced at the moment. And then you wait for the data to come in. And if the data confirm that the disinflation process is on track, I think it's then quite easy to say, look, the data are on track. We want to normalize policy. So I think they want to avoid really committing to a particular path. I think they want to avoid making it a one-way street to 2% in a straight line. And they want to put weight on the data, which, of course, is the right thing to do. But given our forecast of how we think wage growth will evolve and how inflation will return to 2%, I do think it's likely that we're going to see a series of cuts this year.
Tricia used to give us little code words. I wonder if we need to go back to that. Jari, stick around. I want to talk to you about we talked about the monetary side. I want to talk about the fiscal side as well. We'll do that in just a moment. Jari Stehn, Chief European Economist at Goldman Sachs, is just going to stay with us. Coming up as well, a new era of global rearmament. It's gathering pace. This is part of the story on the fiscal front. This is the West contends with growing threats from Russia, China, and also the threats coming out of the Middle East. We'll talk about that story next and what that means for government finances. This is Bloomberg. We've talked about the monetary, let's talk about the fiscal. A new era of global rearmament is now gathering pace, understandably, given the geopolitical risks that lie out in many parts of the world right now. The US and its allies coming to terms with the big increases that are going to be required to counterbalance the threats that we now perceive from Russia and from China and the threats that are coming out of the Middle East. Bhargavi Shaktiwal joins us now to talk about this key economic story that we are covering. Let's talk about the appetite that now exists. We saw yesterday Germany announcing a big deal to increase spending on armoured personnel carriers and frigates. How much political appetite is there in Europe to scale up the defence industry to Cold War scale types of numbers?
Well, defence spending reached a record $2.2 trillion last year, so it's not that far away to think about this increase in defense spending and this appetite for it. Mainly it's being driven by, in Europe, Russia's aggression in Ukraine has been a major wake-up call. And then on the other side, you've got China's rising military might and its investments, which is actually also the looming threat of Beijing moving on Taiwan. We see the political unrest in Ukraine, in Middle East. All of this after years of limited defense spending following the Cold War. More and more European nations are now stepping up and spending more in light of all of these threats. So yes, the appetite is increasing.
In terms of how we finance this, how's it going to work? Is this going to come out of national budgets? Is this going to come out of pan-European debt? What is the current thinking? Because the numbers are big, and it's going to be interesting to see exactly how ultimately Europe deals with this problem.
Absolutely. So we looked at two scenarios, and one of our scenarios is defense spending increasing to 2% for all the countries, and the other one was 4%. And in the 4% scenario, our calculations show that the total numbers could add up to over $10 trillion over the next decade on just defense spending and borrowings to finance this. But where does the money come from? Well, there's a difficult trade-offs for the governments to take. If they borrow more, we're currently in a period of extremely high prolonged interest rates, which would be extremely expensive. It could impact economic growth. It could have further tightenings of government budgets along the way. But on the other side, if they spend it on, if they finance it by cutting spending or increasing taxes, that's also a problem, especially in terms of low economic growth.
Bhargavi, thank you very much indeed. Bhargavi Shaktiwal joining us from Bloomberg Economics on the spending challenges around this defence story. Jari Stehn, Chief European Economist at Goldman Sachs, still with us. On the fiscal front, can Europe do it all? Can it continue to finance welfare at the same time as financing a big weapons program? Can it continue to push on with the green investment challenges that Europe faces as well? Is there the money? Are there pots of money available to do it all?
It'll be a challenge. There are some pots of money remaining. If you look, for example, at the NGU, the Next Generation EU, there's some remaining funds that could be repurposed. There's a little bit of discussion around that. There's also, of course, ultimately fiscal space in the core countries. If you just look at debt levels in Germany, But of course, you have institutional constraints there. So I think there it's a little bit more of a political question rather than an economic one. And so I think it will be a challenge, but I ultimately think that you will find different sources to finance this spending.
Is this the key moment for Europe, though? We had the moment during the pandemic where we did joint financing. And that felt like something that I've been covering this story for ever since the euro was created. And that's been the moment we've all been waiting for, this kind of, we've had the monetary alliance, and now we're starting to get the fiscal kind of common approach being taken as well. I was told at the time it was a one-off. But do you think it is going to be a one-off? Do you think ultimately Europe will decide that actually financing defence, for instance, is something that should be done jointly? And if so, how big a moment is that for the Union, for the Eurozone?
I think we are heading in that direction. I think the creation of the NGEU really was a watershed moment. It set the precedent. It was, of course, meant to be a one-off, but it set the institutional precedent of how you can go about to finance EU-wide programs. And so I think with that precedent in place, I think there is room to build on that over time. It is, of course, a difficult decision for various reasons, for political, for institutional reasons. But I do think we will move further down the line of integration. And we've also often seen that Europe moves when it is under pressure, economically or politically.
But in terms of how pivotal that could be, we've missed we've had the kind of the monetary framework, but we've been looking for the fiscal framework. How far could that take us? Is it just joint financing of big projects? Do we start to see more fiscal transfers in the way that maybe actually you need to have a properly functioning monetary union? Is this kind of the first step down that road?
I think it probably is, but I think it's a slow process. It's a complicated process. I think for now, I think of it more as joint financing of big, more one-off projects. There's also, of course, initiatives around things like capital markets union, which is another important part of risk sharing. We might make some progress there. And then, of course, there are also debates around things like common unemployment insurance, sort of more cyclical backstop. So I think you do have discussions on all of those fronts, but it is going to move relatively slowly. And I think the one-offs are probably going to be the bigger changes for now.
You start to add all the one-offs up together and maybe they start to amount to something. That takes me to my next question about what we've seen, rather surprisingly, is peripheral outperformance within the Eurozone versus the core. And some of that is down to the NG funds and how they're being spent. How big an impact how sustainable is that impact, do you think, in terms of the effect on Italy, particularly Italy maybe, because of you've seen the Meloni government spending an awful lot of money, which has propped up some of the economic numbers that we've been seeing. It has had an effect. In some ways, this is fiscal transfer. Is it something that is going to carry on and can be sustainable?
I think there are two main reasons behind it. One is the fiscal that you mentioned. The transfers, the recovery fund spending is one reason that we are seeing support for the South, and it's a drag on the North. I think that's one reason for that economic divergence. But the other one is, of course, that the South is more services intensive, the North is more manufacturing intensive, and we are seeing more weakness in manufacturing, and we're seeing rising real incomes that is supporting services. So I think there's also an important economic story for that divergence. Now, how long can it last? We do think that this year the South will continue to outgrow the North quite substantially. But of course, we are also seeing that debt levels, for example, in Italy are high. They're probably going to edge higher from here. The deficit has been revised up. And so I think it is a reminder that there is also a narrow fiscal path that some of these higher debt countries are walking. And so we do think that there's going to be a little bit of upward pressure again on sovereign spreads as a result of that.
OK, they've certainly tightened up significantly of late. Jari, great to see you. Thanks very much indeed for stopping by to see us. We really appreciate it. Thank you very much indeed. Jari Stehn, Chief European Economist, joining us from Goldman Sachs. Plenty more still to talk about this morning. We're building, of course, towards that CPI print, and we're watching very carefully what is happening with dollar yen this morning. This is Bloomberg.
We're still investing in China because we see that long-term potential. Transition is taking place. Now is the time to invest, in my view, in China, to be part of that transition and the future growth.
Investors, what I hear here, are looking for these growth companies in China that they've been hearing about, that they've been seeing, that's starting to stimulate secondary market growth.
But we're actually underweight China at the moment. You know, the overhang of the real estate, going into consumer confidence, business confidence. We're starting to see net inflows. We're starting to see those policies coming through.
Some of the HSBC executives that we've been speaking to exclusively at the bank's Global Investment Summit, which has been taking place over the last couple of days in Hong Kong. Some really interesting kind of lines coming out there on what is happening with China. I want to take you as well to what is happening in Japan right now. Keep a firm eye on what is happening with dollar-yen right now. The expectation is that we are going to wait until we see the CPI print out of the States tomorrow before potentially we do see yen intervention in the dollar-yen trade. 151.90. The market seems to think that the line is at kind of 152, but is it slightly north of that before we start to see some action? Anyway, keep an eye on that. Keep an eye on euro-dollar as well, going into the ECB meeting as well. We're going to talk about what is happening in the Middle East next. That is coming up. This is Bloomberg. Tuesday the 9th, European stocks are off the lows, but we are still down. The FTSE 100 is outperforming. We're watching very carefully the yield on the US 10-year. We are waiting for the CPI print tomorrow, but we got north of 440. That's the highest since November. This as the former St. Louis Fed president, Jim Bullard, says 3 cuts for the year from the Fed. Probably the base case scenario. We'll bring you more of that exclusive interview as we work our way through this program. Plus, the Japanese finance minister says he's watching FX movements with a sense of urgency. We're just below kind of that 34-year low. 152 seems to be the key line in the sand that we are watching very, very carefully. Let's talk about the commodities trade as well, because actually that's one of the aspects that we're watching so carefully out of the European story this morning. We are seeing some outperformance coming through from the miners. This as iron ore actually has a fairly solid session out of Asia. That's being read through into some of the European names like Rio Tinto this morning. We've also got oil front and centre, trading near a 5-month high. Investors very much casting a careful eye on what is happening in the Middle East. And we're going to get some supply updates a little later on this week. The IEA and OPEC are also going to be updating us on the supply-demand story. This comes as the JP Morgan CEO, Jamie Dimon, in his letter, calls the stop that we've seen from certain politicians to stop oil and gas projects as wrong and, quotes, enormously naive. Joining us now, Angelina Valavina, head of EMEA Natural Resources and Commodities at Fitch Ratings. Angelina, nice to see you. Let's talk first of all about the kind of the volatility that we are seeing in the commodities market. BP out with numbers this morning, updating us on sales, talking about very strong trading. This is being replicated for some of the other big trading houses as well. Do you think we're going to continue to see the volatility that we've seen in commodities in through the rest of the year?
Commodities markets are generally highly volatile, and we will continue seeing a lot of volatility across different commodities. This includes oil, gas, iron ore, copper, and there are a couple of drivers for that. One is geopolitical risk premium, which is very high across all the commodities. And the second is obviously China and the economic growth in China. If we briefly speak about oil, as you mentioned, oil is trading at around $90 per barrel for Brent, and this is nearly 6 months high. And this is driven by a very high geopolitical premium due to the ongoing conflict in the Middle East, but also the recent attacks on the Russian refineries. And we do anticipate this volatility to continue because on the one hand, OPEC Plus is continuing to manage supply side for oil, but on the other hand, there is a very high spare capacity. It's over 5 million barrels per day. So if there is any significant escalation, for example, in conflict, and there is an uptick in the oil price, it's likely to put a cap. But then on the other hand, there is a moderation in the global demand growth for oil, which is now anticipated at about 1.3 million barrels per day, which is well below 2 million barrels per day we saw last year. And most of this demand is expected to come from China. So whilst the markets are balanced, the balancing act is coming from OPEC Plus continuing to manage the supply side. Okay,
there's a lot in there, so let's just unpack some of it. You talked about the fact that maybe the risk premium, the geopolitical risk premium, is high right now. How high really is it? For a long time, it felt like the market could ignore the geopolitical risk because of the solid supply side story that you referenced there. How much do you think it has increased? If I look at $90 a barrel, how much of that is risk premium? How many dollars a barrel do you think that we're looking at?
It's difficult to estimate from the mathematical standpoint how big is the geopolitical risk premium, but it is usually between $5 to $10 per barrel. And if you think about it, when the supply and demand is balanced and OPEC Plus is managing the supply side, there is a reasonably solid demand growth story. We saw oil price for Brent around $80 per barrel. And this is where we think the geopolitical premium was around $5. But then now it jumped to about $90 per barrel. And this is an expansion of the geopolitical risk premium, if anything.
So how much higher could that geopolitical risk take us? Could it take us, as some are suggesting, towards 100?
It really depends, because if there is an escalation of the conflict, if, let's say, there is an impact on Strait of Hormuz, obviously the oil prices can skyrocket. But as I mentioned, the spare capacity for OPEC Plus is very high. It's over 5 million barrels per day. And that will serve as a cap on any sustainable increase in prices. But having said that, it doesn't remove the possibility of an uptick in oil, of substantial uptick in oil prices if the conflict escalates.
Let's talk a little bit about iron ore. Iron ore up sharply overnight. Is that based on an expectation that we are going to see a Chinese recovery? What do you make of what we're seeing in terms of the trajectory there?
So in terms of the iron ore, the market was relatively bearish during the first quarter of this year. The iron ore prices collapsed from $140 per ton at the beginning of the year to about $105, $103, and our expectation for this year is $105. There are a couple of drivers. One is the bearish sentiment from China. The other one is an increase in inventories in Chinese ports. But having said that, we anticipate the global crude steel production to be reasonably flat this year, and also Chinese crude steel production to be flat. So this will provide the demand support for iron ore. There were a couple of interruptions, operational interruptions on the supply side at the beginning of this year. This provided support to the prices. But then generally the supply side was reasonably strong during the first quarter, and that pushed the prices a little bit down. But taking into consideration the energy transition and taking into account our expectation that the crude steel production in China is likely to moderate in terms of the growth, it's likely to go down over the next 5 years on average, let's say 1 and 2%, that will put a cap on the growth of demand for iron ore. So we do expect the prices to moderate going forward.
Angelina, there's a lot of questions being asked about why we are seeing the rally in gold right now. There's a lot of head scratching going on. Why do you think it's happening?
Well, gold is generally a safe haven. And going back to the point about the geopolitical premium that we discussed, that's the natural reaction of the gold market.
Okay. Angelina, thank you very much indeed. Angelina Valavina, head of EMEA Natural Resources and Commodities, joining us from Fitch Ratings. Thank you very much indeed. I want to kind of explore one element of this story, and that is what is happening in the Middle East in maybe a little bit more detail. Senior Israeli officials are now saying the progress has been made in negotiations for a ceasefire in Gaza. That would include the release of hostages and Palestinian prisoners. It's a move that is drawing criticism from far-right ministers in the Netanyahu government who have threatened to bring down that government. Joining us now, Ethan Bronner, to dig into this. What do we know about how close potentially this ceasefire deal is? Kind of what are the key sticking points still that need to be decided?
Well, actually a fair amount, it looks like. The Israelis expressed optimism yesterday because the Americans, who were sort of the key drivers in this, came to them with a deal that they thought they could deal with. And the difficulty now seems to be that Hamas, on its side, has not responded very positively to what's been offered. We'll see. We think it'll take a couple of days. I think it's about a 50-50 situation. The big issues have to do with Hamas has some fairly strong demands that Israel ultimately, in the beginning, promised it will remove all of its troops and will no longer be involved militarily in Gaza. That's not something Israel's been willing to promise at this stage. And then there's an issue about how and how many Gazans who live in the north of Gaza can go back home from the south. So those are the issues on the table right now, in addition to what kinds of Palestinian prisoners held by Israel, how many and what kind would be released in this deal. So there's a lot still to negotiate. But there is a sense of movement that there hadn't been before.
Will the Netanyahu government survive such a deal?
Well, that's a very good question. They have a meeting tonight at the Security Cabinet. The far-right members of his coalition have said, if anything we're hearing, which is that the Israelis removed their combat troops from Khan Yunis in the southern part of Gaza in the last couple of days, they're saying if this is a sign that we're stopping the fight and we're not going to go into Rafah ultimately, and that you're going to yield to Hamas in this deal, we're going to bring this government down. Netanyahu responded last night with a little video in which he said, we're going to go into Rafah when we need to. We have a date for it. So everyone is talking very hard line, both Hamas and Israel, publicly, and then in Cairo at the negotiations. There seems to be a greater sense of flexibility, but it is very difficult to know where this is going.
The international pushback, though, continues to mount against an invasion of Rafah. The condemnation of how the Israelis are conducting this war getting greater and greater. The Turks are the latest to push back, and we're seeing certainly a trade spat emerging there. In terms of how much that pressure is being recognized in Tel Aviv, in Israel, to what extent is the Netanyahu government responding to it? Is that maybe some of what we saw yesterday in this comment that we got from Netanyahu?
I think it is. I mean, I think that the domestic political needs in this country for Netanyahu is not to be seen to be yielding to international pressure on what's going on in Gaza. So therefore, his pushback is very strong. In the Turkish example you just gave, the Turks have said, well, we're going to take certain items off of our list to export to Israel. And the Israelis have already responded and said, well, we're going to create a list of things we won't allow you to export to Israel. Now, at the moment, concrete and steel are quite significant imports by Israel from Turkey. So I don't think it's going to be pain-free for Israel, but there's a very much, we can take it, we can stand up to the world all by ourselves. We've done it in the past and we'll do it again. That's the sentiment. The reality is somewhat different.
Ethan, thanks for the update. Complicated picture. Thanks for maybe breaking it down for us and letting us understand what's happening here. Ethan Bronner joining us from Israel. Coming up, we're going to take another look at what is happening in the currency markets. The yen holding close to that 152 level. Plenty of speculation around about intervention, but when does it actually come and at what level? And as it posts that CPI print tomorrow out of the United States. More on that next. This is Bloomberg. 43 minutes past the hour. Jim Bullard used to be super hawkish, certainly at the beginning of this rate hiking cycle we've seen out of the Fed. That was the narrative. Sounding a little bit more circumspect now. So he's now formally of the St. Louis Fed. He's now at Purdue University. But he, in Hong Kong overnight, was saying he now thinks that 3 interest rate cuts this year from the Fed, probably the base case. This is inflation moves back towards the central bank's target. He spoke exclusively to Bloomberg's Haslinda Armin from the HSBC Global Investment Summit, which is taking place in Hong Kong.
I think at this point you should probably take the committee and the chair at face value. I think their best guess right now is still 3 cuts this year. And of course, the data can go one way or another, but that's the base case. I think it's been a very successful policy. The policy rate was increased a lot during 2022. And inflation fell quite a bit in the second half of 2023. Last year at this time, core PC inflation would have been 200 basis points higher than it is right now. That's the committee's favorite measure. So you're looking at a very successful policy with a pretty strong economy. So a lot of things going right for the Fed right now.
So Powell has been right so far?
Yeah, I think he's been right so far, and the committee's been right so far to pursue an aggressive strategy to bring inflation back to target. Most of that was in 2022, and then you bore the fruit in 2023 and into 2024 here.
We talk about how the Fed is data dependent. Powell himself says he is data dependent. What exactly does that mean, and which data in particular is he looking at, should be looking at?
Yeah, I think right now it's mostly the inflation data, because on the real side of the economy, things are going very well, and you can argue about why, but they're going very well. The committee doesn't really have to worry about that side of the mandate right now. All they've got to worry about is getting inflation back to the 2% target, and they've come a long ways back already. It was 4.8%, now 2.8% core PC inflation on a 12-month basis. That means you've only got 0.8% to go. And some people are saying that the next report will lead to core PC being only 2.6% on a 12-month basis. So you're starting to get close enough. I think you have enough data in hand right now to justify the first rate cut, maybe not a whole string of rate cuts, but you could certainly justify the first rate cut now based on the data that they have.
We talk about how the U.S. economy is very strong. So would you say that the risk in the U.S. economy right now is inflation and not growth? Fair to say that?
I think that's right, yeah.
Why is the U.S. economy so resilient? I mean, not too long ago, we were expecting a recession, 100% or, priced in of a recession. Yet here we are with a very resilient economy.
Yeah, last year at this time, you had the bank failure of Silicon Valley Bank and other banks, smaller banks around the country. That was overinterpreted to mean that the U.S. was going into recession. I don't think it was ever a good story to tell, because yes, their banks failed, but they're only a small fragment of the total banking and the total intermediation sector in the U.S. economy. So I think that card was overplayed, and not only did the U.S. not go into recession in the second half of 2023, but the economy actually boomed in the second half of 2023. So you really got a very strong outcome, and that has continued into the first part of 2024 here. Although I would say we're going to be closer to the trend growth rate now, not way above trend the way we were during the last 6 months of 2023.
Jim Bullard speaking to us out in Hong Kong at the HSBC event, formerly, of course, of the St. Louis Fed, now of Purdue University. I wonder if he's a basketball fan. If he's not, he probably should be. Let's talk about another aspect to this story, and that is what is going on with the yen. We're all on tenterhooks, waiting for a couple of things, one of which is the CPI data out of the United States. The other one is how the BOJ responds to that. You get a strong print out of the States, as it said, the dollar higher, the yen lower. Does ultimately the BOJ, do the Japanese authorities step in at that point? Aileen Oyamada joins us now on set to discuss. Is that what we're waiting for? We need to get through the CPI print, right?
Yeah, definitely. We will hardly see something before CPI, I would say, because as you said, it will move markets all over the world. But markets are definitely waiting for intervention at any time from Japan. We are at the yen levels now are weaker than when they were when they last intervened. Yep. And the 152 level is widely seen as something that authorities are watching for. And also when you look at options, it's something that is important for the market. So.
The market's not brave enough to go beyond 152 at the moment.
Yeah, that's what you're seeing.
It's kind of we keep bumping up against that sort of level. Is it 152? Is that the line? How fuzzy is that line?
Yeah, so we've been hovering around that level for 3 weeks now, I think. It's not a line that authorities have drawn. They are actually trying to steer away from saying that's the level we will intervene. But it was close to that 30-40-year level, and technically we had some options expires already in that level. So that means markets were positioning for that to be kind of the extreme. And they are trying to avoid testing that, like you said, because no one wants to really defy the central bank at this point.
In some ways, it's a surprise that we are where we are right now. After such a long period of time of negative rates, for the BOJ to come through and hike rates, logically, my mind would have told me that we would have had a stronger yen, but we've ended up with a weaker yen. Do you think this is where you are expected to be at this point, given the policy change that we've seen?
Yeah, so when you look just to Japan policy, you could think about our stronger yen because they hiked rates after 17 years. But when you compare to the rest of the world, yields are so low in Japan. Rates are so low. Yeah. They are just coming out of negative rates. We had this huge, massive rate hiking cycle with the Fed, with the ECB, all over the world, really. So the yield advantage is something that it's really hard to combat when you're a currency trader.
The carry trade's still on and will be on until maybe things change more significantly or they push back. Aileen, thank you very much indeed. Yeah. Aileen Oyamada, having a very busy time right now. Maybe it's going to get a little bit busier. What are we going to talk about next? Airbus and Boeing out with their delivery numbers. Remember, deliveries are really important. That's where these companies ultimately get their big kind of cash push from. How are these numbers going to turn out? Both companies facing their own different problems right now. Maybe Boeing a little more than Airbus. We'll talk about that next. This is Bloomberg. So Airbus and Boeing are set to announce Q1 deliveries a little bit later on today. With a threat to demand from rising geopolitical tensions, what should we expect from these results? I think it's the supply chain story that we're probably going to be focusing on. We know what the problems, we hope we know what the problems are at Boeing, but is it all really plain sailing for Airbus? Benny Campbell joins us now, Bloomberg's global editorial leader on aviation, joins me now on set. We know what the issues are with Boeing. How are they going to manifest themselves in terms of these numbers?
Well, it's really a question of how bad will the numbers be. I think the market is expecting a bad set of numbers. It's just sort of where is the floor at this point. So we're probably expecting, 20, 25 orders in terms of the 737. You've got to remember they're capped in terms of what they can actually do. Yeah. We have the FAA, the regulator. They're sort of checking what they can do, and they've capped the number of output until they're satisfied with the production. So there's really not a lot that Boeing can do at the moment. And they have said deliberately, we want to go slow. So even with a regulator, they're saying we're probably going to do less than that.
We actually need to get this right.
Yes.
Airbus, I think, is a much more interesting narrative because in some ways we've kind of ignored Airbus and we've been focusing very much on Boeing. But they are going through a big supply ramp right now. And I'm wondering how kind of smoothly that's going. What is happening further down in the supply chain? Are they getting what they need in order to deliver the aircraft that they are promising?
It's still a big issue for them, and whenever you speak to Guillaume Faury, the CEO, he still says, look, we're not out of the woods yet on supply chain. Yes, the pandemic's behind us, and yes, things are better, but don't forget they have issues with the engines on the 320, the RTX engines. Those are a problem. A lot of planes are on the ground. They have issues with the bigger planes. So, yes, they want to ramp up, and obviously they're in a much better place than Boeing is right now. But as you say, they still have issues.
So we'll continue to watch. This is still a supply chain story for both, well, certainly for Airbus.
So. Yeah.
Benny, thank you very much indeed. Benedict Campbell, Bloomberg's global editorial leader on aviation. Before we wrap up the programme, quick look at what's happening with the markets. Dollar yen, keep a firm eye on what is happening here. We are watching that 152 line very carefully. There we go. There it is, 151.88. Keep an eye on euro dollar as well. How much divergence are we going to see this week? We've got an ECB meeting coming up Thursday that people, I feel, maybe are ignoring a little bit. You want to pay attention to that. Anyway, the brief is up next. Danny Berger, Manus Cranny, continuing the conversation in New York. This is Bloomberg.